The biggest police tech company in the world just closed a massive, record-breaking contract. But the buyer wasn't even a police department. It was a prison system.
Right. Welcome to the new physical software model.
Exactly. You are listening to Earnings Unscripted, where we unpack what actually happened in today's earnings. Today is February 24th, 2026, and we are looking at the Q4 report for Axon, ticker AXON. It is an absolute wild one, Miro. Huge bookings, huge revenue jump, but also a widening GAAP operating loss. How do we even frame this quarter?
Well, you frame it by completely ignoring the GAAP numbers, apparently. Look, the non-GAAP EPS was $2.15 a share. That is up from $1.17 last quarter. Revenue is knocking on the door of $800 million, specifically $796.7 million. That is up 12% sequentially. But yeah, you mentioned the GAAP operating loss. That actually widened out to negative $50.1 million.
Quick thing, just before we try to unravel those completely opposite numbers, this podcast is strictly for entertainment and our personal opinions, so do not take it as financial advice. Anyway, the market clearly kind of just brushed off that GAAP loss today.
Oh, 100%. The market ignored it. The stock actually had a pretty volatile fourth quarter. It drew down almost 20%. But today, it trended steadily higher all regular session, closing up over 5%. And then, the moment the regular session ended at 4 ET, the tape just went vertical.
I saw that. It gapped straight up from 442 into the low 500s instantly.
Yeah, it hovered around 505 right as the call started, ultimately settled near 514 after hours. So roughly a 16% extended hours gain. And they really feel that by flashing this massive future contracted bookings metric, up 26% sequentially to $14.4 billion.
Which is wild. $14 billion in backlog for, tasers and body cameras. But I guess management's whole argument is that they're totally immune to the SaaSpocalypse happening across the tech sector right now, right? Because they actually own the physical hardware in the field.
Right. That is the CEO's entire moat argument. If you just make software, you can be disrupted by AI. But if you make the physical, literal body camera and connect it to your proprietary cloud, you are locked in. Their software and services gross margin was stellar, almost 77%. But I was going to say, actually, it's not all perfectly bulletproof.
Wait, what part is cracking? Because those margins sound pretty healthy.
The hardware side. Adjusted gross margins on connected devices eroded quite a bit, down to 49.3%. They took a direct hit from global tariffs, but they are papering it over with a staggering amount of software adoption. But there's also this issue with the GAAP loss. They're hiding a roughly $32 million severance cost entirely out of view.
Hold on. Wait, severance? Like structural cuts in a quarter where they just added billions to the backlog?
Exactly. You claim you're entering a golden era of AI bookings, but you terminate enough staff to trigger a $32 million non-recurring charge, which, by the way, they just kind of swept under stock-based compensation lines.
Okay, now that is the kind of discrepancy we need to talk about. All right, let's get into the details on what exactly is hiding inside those expenses.
It comes down to classic accounting gymnastics. They booked this non-recurring severance, roughly $32 million, but if you dig into the footnotes, $24 million of that was equity-based. So they just folded it right into the standard stock-based compensation line.
Wait. So they are basically paying people out in stock to leave the company?
Essentially, yes. And it is brilliant, honestly, if you want to protect your cash flow optics. I mean, operating cash flow bounded to $217 million this quarter. But their GAAP operating loss is being dragged down by this massive $208 million stock compensation pool. It hides the real cash equivalent cost of the layoffs.
Okay, but hold on a sec. Why do so much severance right now? I mean, they just grew future contracted bookings to $14 billion. It feels really weird to make structural cuts in the middle of a massive growth phase.
Well, you have to look at what they have been buying recently. They are aggressively eating the entire 911 dispatch pipeline. They acquired Fusus, Dedrone, and then in Q4 they bought Prepared. Plus, they have Carbone coming up early next year.
Oh, right. So you buy 4 companies. You suddenly have 4 redundant HR departments, 4 redundant marketing teams.
Exactly. It is a stealth restructuring. They're culling the overlap from this entire M&A and AI spree. But by hiding that severance inside the equity pool, the actual operational pain gets totally masked in those GAAP figures.
That is quite the magic trick. But it also speaks to a huge strategic shift, because earlier we touched on that whole SaaSpocalypse idea, and the CEO was just so confident on the call. He literally said, and I'm quoting here, "I would not want to be a software-only company right now. I think this whole SaaSpocalypse has got some real risk to it. You have to own the full stack, including hardware." And we do.
Which is a phenomenal quote, and he's right. He's entirely right about commoditization. If you just build AI software, eventually somebody will undercut you. But if your AI is intrinsically tied to a physical body camera or a TASER, you become the physical node. It creates an insurmountable moat.
And they're really expanding that node. It's not just the cop on the street anymore. It's the community traffic cameras, the drones, the very first 911 phone ring. It feels like they're trying to stitch together the entire life cycle of an emergency, from the first dispatch all the way to the final courtroom evidence file.
Yes, but, I have to bring us back to the reality of the balance sheet here. Building that physical infrastructure is not cheap, and they are playing another little illusion with their cash flow projections for next year.
Oh, come on, Miro. You cannot just let them have one clean win, can you?
Look, I just read the numbers. So, they gave capital expenditure guidance for 2026, roughly $185 to $215 million, which sounds very disciplined, right? It keeps their adjusted free cash flow targets looking absolutely pristine.
Okay, I definitely hear a but coming.
But they conspicuously added a caveat that this guidance excludes costs related to investments in a new headquarters.
Wait, what? A new HQ? How much is that actually going to cost?
We have no idea. It is a black hole. They completely carved it out of the guidance. So Wall Street models are going to price in this incredible free cash flow while totally ignoring a potentially massive cash drain hitting right in 2026 or 2027.
Jeez. So they are effectively saying, look at our amazing capital discipline. Just please ignore the shiny new corporate campus we're building off the books.
That is exactly what they are doing. It is entropy with better marketing.
Okay, so between the hidden severance and the ghost headquarters, this whole earnings report is like an optical illusion. It's fascinating, really, but it makes you wonder when the bill actually comes due. So where does this leave them heading into next quarter?
Well, look, the bill is already hitting them on the supply chain side, actually, but they are managing those expectations incredibly well.
Wait, on the supply chain, are you talking about the global tariffs? Because we did see hardware margins slip this quarter.
Right, down to about 49%. But here's the thing. They baked a 50% global tariff straight into their 2026 guidance. No government refunds assumed at all, and they still project over 27% revenue growth.
Okay, that is honestly a massive flex. They're basically telling the market we can take a 50% tax on our physical goods and still thrive. And they're opening up too, right? With that Works with Axons program.
Exactly. It used to be a totally closed loop. Now they let third-party cameras connect to their network. So a city can buy cheaper sensors, but Axon remains the central hub for AI and data storage.
Which is brilliant. They get the high margin SaaS revenue either way. It is like they're becoming the default operating system for public safety, especially with them moving into prisons and corporate retail now.
Precisely. They are building a toll booth. But looking ahead, the big unknown is just raw execution.
They have bought a ton of companies. Next quarter, I want to see if they can stitch all these software pieces together without margin creep in services. Implementation takes human consulting, and that is expensive.
And I imagine investors are going to hold them to that promise on stock dilution too, right? Did they say capping it under 2.5% a year?
Yes. After this year's massive stock payouts, Wall Street will be watching that specific metric like a hawk. But if they execute this integration, their anti-commoditization thesis really holds up.
So basically, they own the entire incident timeline now. If a 911 call happens, Axon is probably processing it. It's an expensive monopoly, but, well, a monopoly nonetheless.
Hard to bet against gravity when they own the floor.
I love that. I think that's the perfect way to wrap this one up.
All right, that is enough damage for one episode. If you want these earnings drops to just magically appear for you, you might want to follow the podcast. Just a quick transparency note, we do use AI tools to help pull the filings and transcripts so we can actually summarize what matters here. So if there is a ticker you want us to dig into next, just shoot an email over to earningsunscripted@datamadness.ca or find our X link in the show notes, and we will catch you after the next bell.
Keep reading the footnotes.